Financial ratios are essential tools for analyzing a company's performance and financial health. They provide insights into profitability, liquidity, efficiency, and solvency. Financial ratios are quantitative measures used to evaluate the financial performance and health of a company. They help in analyzing a company's liquidity, profitability, efficiency, and solvency, aiding in decision-making for investors, creditors, and management. Liquidity ratios measure a company's ability to cover its short-term liabilities. The current ratio is calculated as current assets divided by current liabilities. This shows whether a company can pay off its short-term liabilities with short-term assets, with an ideal range generally above 1. The quick ratio, or acid test ratio, is calculated as current assets minus inventory, divided by current liabilities. This is a more stringent test than the current ratio, as it excludes inventory from assets, with an ideal range typically at 1 or higher. Profitability ratios indicate how well a company generates profits relative to sales, assets, or equity. The gross profit margin is calculated as revenue minus cost of goods sold, divided by revenue. This shows the percentage of revenue remaining after deducting the cost of goods sold, with higher gross margins indicating efficient production or strong pricing strategies. The net profit margin is calculated as net income divided by revenue, measuring the percentage of revenue left after all expenses, taxes, and interest, with higher values indicating better overall profitability. Return on assets, ROA, is calculated as net income divided by total assets, showing how efficiently the company uses its assets to generate profit, with higher ROA indicating better asset utilization. Return on equity, ROE, is calculated as net income divided by shareholders' equity, reflecting how effectively a company uses equity to generate profit, with high ROE indicating efficient use of shareholder funds. Leverage ratios assess a company's long-term solvency and risk by examining the company's debt levels. The debt-to-equity ratio is calculated as total debt divided by total equity, indicating the proportion of debt used to finance the company's assets relative to equity, with a lower ratio suggesting less risk, though this varies by industry. The interest coverage ratio is calculated as EBIT divided by interest expense, showing how easily a company can pay interest on its outstanding debt, with a higher ratio indicating better debt servicing ability. Efficiency ratios measure how efficiently a company uses its assets and manages its operations. Inventory turnover is calculated as cost of goods sold divided by average inventory, measuring how many times inventory is sold and replaced over a period, with higher turnover implying efficient inventory management. Accounts receivable turnover is calculated as net credit sales divided by average accounts receivable, showing how quickly a company collects payments from customers, with a high ratio suggesting efficient credit management. Asset turnover is calculated as revenue divided by total assets, measuring how efficiently a company uses its assets to generate revenue, with a higher ratio suggesting better asset utilization. Valuation ratios provide insight into how the market values the company relative to its financial performance. The price-to-earnings, PE ratio, is calculated as market price per share divided by earnings per share, indicating how much investors are willing to pay per dollar of earnings, with a lower PE possibly indicating undervaluation, while a high PE suggests future growth expectations. The price-to-book, PB ratio, is calculated as market price per share divided by book value per share, comparing a company's market value to its book value, with a ratio below 1 possibly indicating that the stock is undervalued. In summary, financial ratios are vital for assessing different aspects of a company's performance. It is important to combine multiple ratios for a holistic view and always compare with industry benchmarks and historical data. I encourage you to use these ratios as tools for deeper financial analysis.